Let's talk about liquidity. This is one of the most common questions I get asked all the time. By now, you probably learned how to identify important liquidity levels, things like hourly candle highs or lows, maybe the daily, weekly, or monthly highs or lows. You also seen setups like equal lows or relative highs or lows. Now, the next big question we should ask is, let's say that significant liquidity level is hunted. What happens next? What should we be paying attention to? And what kind of price action should we be watching for? Once a major liquidity level is taken out, the first thing you should do is just wait a bit. Take a step back and watch the price and really observe what is really going on here. See how the market reacts right after the liquidity hunt. Usually, there are two possible outcomes. Either the move continues in the same direction or it reverses. For example, if the price struggles to push back up and can't make any meaningful break of structures, what we call a market structure break, that liquidity level often turns into a new support and resistance flip zone, and the move just keeps going on in the same direction. On the flip side, if the price jumps back in and starts break off structures or creating new market structure breaks, that's usually a sign of a reversal forming. And this is exactly why it's so important to wait a little bit after a liquidity hunt before jumping in. We need that extra time to see what the market really wants to do. Because honestly, no one in the world can know for sure what will happen right after a liquidity hunt. Now let's take a look at this Ethereum chart. Ethereum had a really significant liquidity level here. We are talking about 4-hour candle low level, also the previous week's low level, and there is relatively significant equal lows around this area. So overall, we had a bunch of liquidity levels lining up, and the price hunted this zone with a really strong and fast move. Now the question is, what usually happens after a liquidity hunt like this? If you look closely, the market structure breaks on this lower time frame. Then the price makes a little pullback into this inner BPR area. After that, it runs back up toward this inner equal highs level above, which becomes our clear target. If you zoom in on this area, you can actually see the price action very clearly. It is not complicated at all. In fact, this is one of the core setups combining smart money concepts and basic price action. That is why it's important to watch how the price behaves after major liquidity hunts. You want to see whether it keeps following the existing trend or starts breaking structure and signaling a possible reversal. Let's talk about how to take trades and shift our bias or direction on the fly as the price action keeps changing. For example, in a crashing market, when the price pulls back into a multi-imbalance area, usually lining up with a supply order block, what is the first thing we normally think? We naturally want to follow the overall trend and ride the move down with it, aiming for a clear target like the previous day's low. That idea is simple, and honestly, it is usually the right approach. But the truth is, it doesn't always play out the way we expect. And if you get stopped out, that's completely normal. So when the order block and the imbalance fail and you get stopped out, what can you actually do next? What should be your next move? We have to start thinking about how the structure is shifting and how the internal trend might be changing after a big failure like that. What usually happens after you stopped out is that the order block, that failed order block, and the imbalance can flip into a support and resistance zone. And it can actually help guide your new direction toward a fresh target like the previous day's high above. And this is exactly how you adjust your bias and switch direction on the go. when a trade fails or you get stopped out. Let's check out this Bitcoin chart. This setup is a mix of 1 and 4-hour time frames so we can get a clearer look at the price action from both angles. And we got some clean targets sitting above and below the previous day's high and low levels, with the price right now stuck in the right middle of everything, as you can see. So, Bitcoin has been in a pretty strong bearish move over the past few days and weeks, and this 4-hour imbalance is showing me that the bears are still in the control and pushing the price downwards. When you switch to the 1-hour chart on the left, you can see the 1-hour imbalance lining up with a 1-hour order block supply zone. Price also forms this inner liquidity level. So naturally, I'm expecting the price hunt that inner liquidity, tap into the multi-imbalance area with the order block, and drop into the previous day's low. This is option 1, and honestly, the most natural and likely move we could get. Our second option is that the imbalance and order block fails, flip backs into a support and resistance flip zone, and price goes after a new target like the previous day's high. As you can see, we created 2 clear options here. So I am expecting option 1 to play out. And if that fails, then I will look for the option 2. As you can see, option 1 played out really well. And this was the clean move that we were expecting from the start. Okay guys, this is how you build your trade plans on the fly before things happen. Now let's talk about the next day and what actually happens during that session. First of all, we get a new previous day's high and a previous day's low to work with. And when you check the 4-hour time frame, you can see a pretty clear and white imbalance zone sitting here. And if you drop down to the 1-hour chart on the left again, you will notice 1-hour imbalance lining up with an order block. So, what do we expect in a spot like this? Now, if I had to put my money on it, I would short this setup again. It looks almost identical to the setup we had the day before, right? What I expect is the price pull back into this multi-imbalance area, tap the order block, and then dropping toward the PDL, take out the previous day's low. The exact same play with the previous trade, right? And okay, next possibility is still on the table, which is more of a low priority option for me, is that the order block and imbalance fail, and price pushes higher to go after the previous day high. But as you can see, this time my first idea did not work out, and that main play to target the previous day's low completely failed. Instead, the imbalance and order block didn't hold and failed, and the price just shot straight up to hunt the previous day's high above. As you can see, it really does not matter how clean or how high quality your setup looks, because some days the trade will still fail. And you got to stay flexible and open-minded, enough to flip your direction and adjust your bias when the price action tells you to do so. You can't just walk in saying, I'm gonna hit the previous day's low all day long, I'm gonna take all the shorts. No, you gotta adapt to what the price is actually doing. Let's talk about how to find the best setups before they actually happen, and how to spot those great price action points where we can take trades confidently. For example, when you look at this chart, what do you think is the best setup? What is the first thing that catches your eye here? For me, when I take a step back and look at this chart overall, I would say a 2-hour setup with a limit order looks like a solid trade idea. This will be the setup I would personally consider taking. But how I really made the decision on this one? The first thing that jumps out at me is this large multi-imbalance area. This kind of imbalances is usually one of the easiest ways to spot potential entries in the market. Then, if you take a look over on the left side of the chart, you will notice a very strong support and resistance flip zone. Price has rejected this level several times in the past, showing that it's a really reactive area. Finally, take a look at this inner liquidity level right here. This is what we call as inducement. Inducement is basically the fuel behind the price before it makes a big move. Now, when you combine these inducement zones with other imbalances and support and resistance flip locations like this one here, that is when you start getting some really clean and high probability trade setups. One of the best point of interest, the POI areas. So the ideal move we would expect here something like this. Price moves down first, sweeps that inner liquidity as inducement, taps onto a large multi-imbalance area along with the support and resistance flips, and then rallies up to take out the previous day's high and even the previous week's high. That is the kind of setup that looks absolutely perfect on paper. A+++ setups. However, what actually happened here a little bit different. Price never put back into our entry zone at all. Instead, it just went straight up and hit the targets without giving us any entry opportunity. Now that brings us to the important part. How do we deal with trades like this one before they happen? First of all, if you look closely, you will notice that the price starts making higher highs inside the structure, which means buyers are still control here. At this point, you got a decision to make. You can split your orders into two parts, using half your risk on this inner breakout and setting up another limit order at your original, the ideal position. Because in my opinion, there's a still good chance the price will pull back into that original trade area. This setup would be a really smart move to use. This is what we call order management. Your second option is to use what we call as ladder orders, risking around 0.3R on each trade, but going for a bigger reward on every setup. This method is known as a ladder trading in order management. It is another classic way to split your entries, especially if you are not totally confident with your first entry. And lastly, one of the most common order management strategies is creating an average entry price, something I teach in my masterclass as the yo-yo entry style. This is actually one of my favorite techniques for managing trade entries. With this style, you almost never miss any entries. But keep in mind, your profit can be a bit smaller or larger depending on where your average entry ends up. So now, you've just seen 4 different entry models and order management techniques around inducement areas. But here is the question, what do all of them have in common? No matter which order management style you go with, the main rule stays the same. You never risk more than 1% total on single trading management. You can risk less than 1% if you want, maybe a total of 0.5R. But most of the time, do not go over the 1% limit. How you split your orders really depends on your quality of the trading setup. If you are feeling unsure, a little bit confused with the setup, or not fully confident, just lower your risk and split your order into smaller pieces. Yeah, you might take a little less money as reward, but you will protect your account, and that's what really matters in trading. Now let's talk about how to read market structure and get a solid idea of the price action on any chart. Here we are looking at a 5-minute Bitcoin chart that shows 2 specific liquidity levels as your main targets, the previous day's high and the previous day's low. We also have this nice area of equal low sitting below, which acts as another clear target for the price. When the price gets really close to the previous day's low, or the PDL, you can see that the trend has been pretty bearish overall, and there is a clean support and resistance flip happening around that zone. At this point, the structure is clearly trending down, heading right toward the PDL. We confirmed this. So taking a short trade here wouldn't be a bad idea at all. You get a clear target downside, a bearish structure going on, and a nice SR flip and imbalance area lining up perfectly. Everything looks great on paper. But this is where the reality of trading hits you. This setup actually failed, as you can see, and that's okay. That's how trading works sometimes. A little later, the price broke up really strongly, moving up fast and getting close to the previous day's high, or the PDH this time. Now you can clearly see that trend has shifted. The lower time frame is showing higher highs, meaning the momentum has flipped bullish. This is your moment to switch your bias. The short-term trend is now up, making new higher highs and heading straight toward the PDH target this time. Since the structure has shifted upward and is now moving toward the high level, your trade idea should flip too, looking for long setup instead of short ones. You want to take those long trades on a nice pullbacks, ideally around SR flip zones or imbalance areas. As you can see, whether it is a short or long trade, the core idea stays the same. Sometimes it works perfectly, and some other times it just fails. That is the reality of trading, and every trader has to accept this truth. Now let's take a look at the Ethereum chart, which actually has a pretty similar chart to Bitcoin. The trend was quite bearish at one point, constantly making lower lows. So taking a short trade during that time wasn't a bad idea at all. It was actually a pretty solid setup. But then, at some point, the internal structure shifts. The price starts to pushing higher and higher, making new higher highs over and over again, and it begins moving strongly to the upside. Now, at that stage, you need to ask yourself, where is this bullish short-term move heading towards? And the answer is simple. It is heading towards the PDH, which stands for the previous day's high level. Along the way, the price gives small entry opportunities for both bigger positions and quick scalp trades. But the real question is this: how do you trade this? Because every trader has a different lifestyle and trading routines. Now the first option is for people who are super busy. If you are someone who does not have much time to sit and stare at charts all day long, setting up these bigger, longer-term setups will work best for you. The target is clear, and since the lower time frame is showing a bullish trend, you can simply set your trade and use a slightly larger stop loss. Try to aim for around 1.5 or 2 hour maximum on these setups. It is a great approach for busy traders who don't want to constantly watch the screens. And the second option is for more active traders, the ones who can spend maybe 3, 4, 5 hours a day watching the charts. For you, it is better to take smaller scalp trades, which in the same direction as the PDH, always following the low time frame structure and the trend. As you can see, there are different trading styles and approaches that can fit just about every type of trader out there. Today, let's talk about how to read price action step by step and how to figure out the bias and the trade direction. For example, when I look at this chart, what I see is the PDH, the visible target up above. And down below, when I look at this multi-imbalance area, I also see this SR flip location. When you spot these inner swing failure patterns with big rejection waves, you can say we have a very tradable area here. So all in all, what is the expectation here? The expectation is simple. From our entry area, we should rally towards our target, the PDH area, the previous day high. As you can see, this is not a complicated analysis at all. It is actually a very simple method to find out bias and a trade direction. Okay, we have taken out the previous day's high, which is great. So now what is the next step? When I look at this chart, I notice these really clean equal highs sitting above. And right here, we've got this inner support and resistance flip area, along with the PDH zone acting as an amplifier. So my expectation here would be a bounce from this PDH area, following the overall trend, and then taking out these equal highs above. Now this zone with multiple imbalances and those inner swing failure patterns looks like a perfect spot to look for entries. So in the end, my expectation is pretty straightforward again, a bounce from the PDH, powered by those multiple imbalances and swing failure patterns aiming to take out the equal highs above. But hey, look at what actually happened here. Our trade failed really badly, and we ended up losing money on this one. It does not mean the trade idea was wrong, it just did not work out this time. We are out there searching for some kind of holy grail pattern that works 100% of the time. Stop wasting your time, it does not exist. If you can win, let's say 6 or 7 out of every 10 trades, also lose 3 or 4, you are doing really great. That already makes you a solid and consistent trader. So at the moment, we've got one winning trade and one losing trade. So what do we do next? Let's look at the price action, see what it's telling us. Since the previous day's high didn't really hold and it is broken really badly, it is pretty clear that the price is weak and dropping hard when you look closely. This multi-imbalance area and the BPR zone could actually be an interesting signal to watch. Also, when we start to see these inner swing failure patterns forming, that can often be a bearish sign. On top of that, we've got this nice equal low sitting right below, which makes a very clear target underneath us. So yeah, you lost the last trade but won this one. That's just how trading goes. You win some and you lose some. There's no such a thing always winning, or there's no such a thing as always losing. It is always a mix of both. That's the true reality of trading. At the end of the day, what we do is not overly complicated. In your trading, the goal is always to look for a clear possible targets and figure out a strong direction to trade toward. So this is the core of finding your bias. We talk about this kind of targets a lot in this channel. But to actually move toward a target, we need certain confirmations to fuel the gas stations, which is likely liquidity sweeps, imbalance taps, or maybe SR flip areas. And one of the most important thing is always to check is the lower time frames. Are we trending in the lower time frames? Are we making higher highs and higher lows that line up towards our main target? This is really crucial stuff to pay attention to. Like I said, it is not overly complicated. Once you get used to reading price action, it all starts to make sense and flow naturally. Today, let's talk about changing bias and what kind of price action we should pay attention to when we are thinking about shifting our directional bias. If you look at the Solana chart on 3-minute time frame, you will notice two distinctive liquidity levels. At the bottom, we have the previous day's low and the previous week's low together. At the top, we have the previous day's high. We also have this relative equal low string below acting as some extra confirmation for our directional bias. And we got this small parabolic liquidity sting above, combined with the previous day's high. If you check out 4-hour chart on the right, you will see this gigantic bearish imbalance right here. This becomes important because it lines up with a very specific price action zone. Price sweeps the inner liquidity and reacts to this inner support and resistance flip zone. So what should we expect here? In my opinion, we should be looking to take a short trade right here, because this is what I'm expecting to play out. This feels like a solid idea, and it lines up nicely with all my patterns and concepts. But the reality is pretty cruel, because you can have a strategy that wins 90% of the time, but it can still fall apart on you. As you can see, this trade and the price action ended up failing really badly. This 4-hour imbalance was completely broken and it didn't work the way it was supposed to be. Instead, we are now seeing a strong bullish imbalance forming on the 4-hour time frame upwards. Then this happens. When you look at the structure, you can see it making new breaks one after another, pushing higher toward the target, which is previous day's high. This gives you endless small imbalances inside to move, letting you take a quick little trades along the way. So how do we adjust our directional bias on the fly? And what should we actually pay attention to? You follow the imbalances and liquidity and you connect all of that with the structure. For example, inside this big hourly bearish imbalance, we would normally expect the price to follow the structure and trend, dropping and crashing badly towards the previous day's low. This is what should we expect. This is the natural move here. However, the big bearish imbalance fails like in our example and the inner structure starts breaking upwards with a strength. We need to be extra careful and think about our bias. It becomes very likely that the trend or directional bias has shifted now, and the price might be hunting a new target such as the previous day's high above. So when you are trading, do not get stuck on a single bias. Price is constantly moving and can switch targets within the same day. There's nothing fixed or guaranteed in the markets. You need to adjust to whatever is actually happening in real time. If you follow me on Twitter, you know I kept saying I was expecting a big crash down to around 90 or even 80k over the recent weeks. So even though I am a naturally bullish guy who usually focuses on long trades, there was something pretty obvious going on. The short opportunities were just much better for traders over the past few weeks. For example, in this Bitcoin chart, you can clearly see we've got a couple of multi-imbalance points that line up perfectly for short traders. And they are combined with these clean inner swing failure patterns. So this becomes a really strong area to look for short trades. And on top of that, we've got this clear target sitting below the previous day's low, which basically gives us a nice directional bias. As you can see, it becomes really easy to spot potential trade areas just by using this simple multi-time frame analysis. And when you drop down to the lower time frames besides the previous day's low, there is also this tiny equal low area that can act as another target and gives us some extra directional bias. So right at our multi-imbalance and swing failure pattern area, you can see a clean structure shift downwards on the lower time frames. And you can also spot this very nice 3-minute breaker block area. Well, breaker blocks are basically just a fancy name for support and resistance flip zones. If you look closely, what is happening here, it is really just an SR flip and nothing more. Additionally, price is also coming right into the EQ point of our premium and discount zone. So, how do we actually trade this? Now let's talk about that. Let's take a look at our trade area again. When I was looking at this chart, this 3-minute imbalance zone sitting right above the breaker block felt like the perfect entry zone. But if you take a short trade from the breaker block, which acts like a inner support and resistance flip, is totally fine. This would give you around a 1.5 hour setup, which really isn't that bad at all. But in my opinion, the best entry spot was still this inner imbalance sitting just above the breaker block. That way you could grab a quick 2-hour setup without stressing or overthinking the whole thing so much. However, I know a lot of you struggle with this kind of entries or waiting around in front of the charts for hours maybe. In that case, your best move is building your entries using dollar cost averaging, kind of like a simple masterclass yo-yo system. What you do is pretty straightforward. First, you jump into a trade. Usually, it can be a market order, basically anywhere you want. You don't need to be super precise on your first entry. This is your first order, and it gets you into the trade. Now, for your second order, you place a limit order at a key strategic level, which would be that inner imbalance area right above the breaker block and inside the discount zone of the premium to discount range. Now, with this style trading, you never end up missing a trade. And in the worst case scenario, you just create an average entry. What you are looking at here is the 5-minute chart. What we are going to do is a bit reverse engineering starting from the lower time frames and working our way up to the higher time frames. By the end of this, you'll understand how to take trades using only high time frames with confidence. Now, pay close attention to this significant price point. It is really important to notice. Here, the price sweeps through this inner equal low liquidity. This is often called as a liquidity grab, which happens right around an SR flip location. That's where support turns into resistance, or the other way around. After that, the market pushes up and rallies straight towards this obvious target, the previous day's high. As you probably know, this setup comes from a low time frame, and it is a very classic trading pattern that we often rely on. Now let's move over to the higher time frames, mainly focusing on the hourly charts. Notice the significant multi-imbalance zone, which forms exactly at the same spot where our inner equal low was swept. At the same time, you can clearly see that we have multiple swing failure patterns supporting our trade. So if you zoom in carefully on the higher time frame, that is what you will notice. The earlier low time frame price action we talked about all happened right within this area. Now I've switched over to the 2-hour time frame only just to take another look at the price action. Remember, this is the same asset, same price action, but this time with that eagle vision view comes from using only higher time frames. From our analysis on the lower time frame, we already knew we had a clear target above the previous day's high. And do you remember those equal lows that basically wiped out liquidity? Yeah, this is the exact same spot. But now we are seeing it from the perspective of the higher time frames. We also had that big imbalance zone where price came in, swept the liquidity, and tapped right into it. And finally, we have the SR flip zone. Do you remember it from the lower time frame analysis earlier in this video? This is the exact same area. Okay, if I were to trade this chart just based on the 2-hour only, without even checking the lower time frames, what would I actually do? Well, my ideal entry would be right where all the 3 price actions came together. This equal low liquidity sweep area, the imbalance tap, and the SR flip zone. So it would make sense to place a limit order right around that level, right below the equal low level. For my stop loss, I would keep it below the big imbalance area just to give the trade enough breathing room. The reason is we never really know how far the price might pull back. There's no solid data guarantees an exact reversal point. Finally, as for my target, I would keep it pretty tight. Maybe a maximum of 2R or even 1.5R if I want to stay safe. I wouldn't hold for the full move all the way to the target because price can get really choppy and take a long time to clear that level. We just don't know how long it will take. Remember, we use targets like the previous day's high or previous week's high mainly as a directional bias. We expect the price to move in that direction, but we never really know how long it will take to actually get there. Check out this Bitcoin chart. The first crash happened right at this multi-imbalance point. Then I was watching the second multi-imbalance point expecting another drop from this fair value gap area, possibly all the way down to the 90Ks. The structure looked almost identical, both showing similar swing failure patterns forming together. But this time the pattern didn't play out the same way. The big crash never came like before. Instead, we saw a strong pullback in the opposite direction. So, what actually happened here? When I started checking the lower time frames, I noticed this nice PDL level showing up below. It was lining up with a clean equal low that looked like a clear target area at the bottom. My trading plan was pretty simple. After the price reacted to that multi-imbalance point from the high time frames, I waited for a structure shift in the lower time frames and looked for a quick 2R setup. At first, the trade was actually going great. It almost reached a 1.5R profit. But then things started to slow down and eventually the trade failed. And now you might be asking yourself, why? What went wrong? But honestly, there isn't always a clear reason. Every trading strategy, no matter what, how good it is, it will sometimes work and sometimes fails. So there is no such a question you should ask, why? Why did it happen? It is just the reality of real trading. And then there was this Nasdaq chart that showed up a big multi-imbalance point right in the middle. It was supported by several swing failure patterns, along with the small support and resistance flip point. Overall, it looked like a perfect area to look for a short entry on the lower time frames. As you can see, this is the exact same chart with the Bitcoin. When you zoom into those lower time frames, you can clearly see the equal lows right below. Another clear target, an obvious target for us, just like the Bitcoin chart that we previously looked at it. At that multi-imbalance point, the market swept all the inner liquidity and then shifted the structure downward. After that, the market just kept dropping until it completely cleared those equal lows. Now you might ask again, why did that happen this time? And honestly, there isn't always a clear answer. Most traders keep asking, why did my trade fail? But they rarely ask, why did my trade win when things go right? The truth is, markets can move in a pretty random ways day-to-day basis. Any strategy, no matter how solid it is, might perform amazing one week and then completely fail the next week. But if you keep applying the same approach, concepts, and patterns consistently over time, you will build a statistical edge that can actually make you profitable. Let's talk a bit about the recent price action in Bitcoin and Ethereum and go over a few important price methods and concepts. Lately, the market has been pretty bearish mainly because of the growing tension between United States and China. If you look at the charts on a daily basis, you will notice that institutional levels like the previous day lows combined with these perfect equal lows make for some really solid trading targets. Now I am naturally a long trader. I honestly hate taking shorts. But sometimes you just cannot ignore what the price action is telling you. We are definitely in a bearish moves nowadays. And right around this SR Philip location, there were some amazing trading opportunities for us. Someone recently asked me to talk about order blocks, and honestly, they are pretty simple once you get the hang of them. A bearish order blocks, for example, is basically the last few consecutive green candles in a row that end up causing a big drop or break in the market. In this example, you can actually see a series of 3 order blocks made up of multiple green candles. What is happening here is not all that complicated actually. Since the overall bias has been bearish, those order blocks kept pushing the price downward, and the SR flip areas gave us some really nice entry opportunities. Even though the market's been rough, we can still stick to clear trading methods. First, you want to find a clean target, something like the previous day's low combined with equal lows. Then make sure the overall lower time frame structure is bearish and moving towards your target. So as you can see, we combine a couple of things together. I hope these methods make sense to you. If you apply them properly, they can help you improve your trading results. When I was checking the Bitcoin chart, I noticed it had a really similar structure, especially this area with the SR flip and the order block above with an imbalance. That could have been one of the best possible short entries. However, as you can see, price never put back to that entry level. And that's just the reality of trading. You might have the perfect setup, perfect entry points according to your strategy, A+++ setups. But sometimes price just does not pull back at all. So instead, what actually happened here? First of all, price started making these inner breaks, probably aiming toward the PDL. That is the previous day's low level. It used this inner order block combined with the imbalance and also reacted around those inner SR flip zones. So in the end, if you just wait for one perfect setup, you might never take a trade at all. Sometimes you got to adjust your risk and take trades that might not be the perfect, but still make sense within your plan. Trading is rough and it is never going to be easy because these markets are unpredictable and quite challenging. Today, let's talk about how we can tell when the market conditions are changing and how we can adjust to them in a smarter way. As you know, price always gravitates toward liquidity, especially institutional liquidity that it wants to sweep, like the previous week's high or day's high. So when you see clear targets and strong bullish structures like multiple imbalances, demand order blocks, or support to resistance flips, you start forming your trade ideas. You are looking to take a clean, compact, long trade right here, and it is the right idea. And if you are in a hurry, you might even place a limit order just like this one. And honestly, this setup is a valid and solid, and there's nothing wrong with taking this trade. But somehow you still get stopped out. The setup just doesn't play out. And that's when you need to pause and ask yourself a few questions. Is the structures failing or not? Do we have a new direction forming and maybe a closer target here? Where is the nearest liquidity that might actually matter right now? Because in this example, you will notice these bullish structures aren't holding up really well and they are getting broken. And this is the moment where we need to accept that the direction has shifted. Price is now hunting a completely different pocket of liquidity. So when you start seeing multiple bearish imbalance zones forming, along with the failed bullish structures, you can flip your idea and look for trades in the opposite direction. And there's absolutely nothing wrong with doing that. Actually, this is what happened with Bitcoin this week. Price had these weekly and daily high liquidity levels sitting above, And we also had last week's low sitting below. But I was mostly focused on those upper targets and kept thinking about taking a long trade. We had a bunch of strong bullish structures forming. First of all, this inner liquidity got swept. Price then pulled down into this multi-imbalance area where that deep order block was sitting. So if you placed a limit order somewhere around that zone and just left the charts alone to go to do something else, it honestly wouldn't have been a bad idea at all. In my opinion, this was actually a really solid setup. But sometimes the quality of your setups doesn't matter at all because the market can crash out of nowhere suddenly. If you look closely here, what happened is that price changed direction for much closer target now, which was the last week's low acting as the main liquidity for us. And our multi-imbalance area with that demand order block completely failed to hold the bullish movements. After that, the rest of the price action was basically just simple multi-imbalances move aiming to take out the previous week's low. So the whole point of today's lesson is that when bullish or bearish structure starts to fail, it usually means we are shifting our bias and the market is heading towards a new pool of liquidity. Let's talk about how to build positions based on our strategies and directional bias we have. As you already know, when we spot clear targets like the previous day's high, we always ask ourselves how the price could realistically reach that level. We usually look for cheaper, solid points of interest, especially things like the multiple imbalances. But sometimes that alone isn't enough. And that's why we also pay attention to supportive structures like the demand order blocks. This combination gives us a really strong area to build our trading setups. Our most classic entry model is opening a lower time frame and watching for some kind of structure shift. And honestly, this is probably the most common entry type you already know and we have been using for quite a while. The problem is that this method requires a lot of waiting and being extremely precise and patient with your timing. The alternative method is building a cost average inside your entry zone. For example, let's say we have a large imbalance area with this demand order block sitting right below it. This basically gives us a very wide and flexible entry location. So what you do is place your limit orders throughout that zone in a strategic way so you can build an averaged position. In reality, we have no idea how much the price might chop around or struggle inside that area. It could take a while, but the good part is you don't have to sit and wait for the perfect moment anymore because you're entering slowly and steadily. Let's check out everything in a real time and see how we can actually build these positions. Solana gave us a really clean example recently on the 4-hour time frame. We had the previous day's high sitting above the price as a clear target. And we also had this huge 4-hour imbalance area lining up with a demand order block. So overall, we already knew the direction and the possible entry area. And you can see how simple it looks, right? But if it is really that simple, why is it so hard to trade it? Because waiting for a structure to shift on the lower time frames takes a lot of time and patience. What I like to do is set 3 different limit orders right at the key spots. You can place your first order at the start of the imbalance, then your second order around the EQ of the imbalance, which also lines up with a support and resistance flip area. And finally, your last order can be placed right on the order block area, the demand zone. So what is the real benefit of doing this? The benefit is you are not waiting around for anything to enter anymore. You already placed your orders. But as you can see in this example, not all 3 orders get filled. The last one was a bit too low to trigger. And that's tough reality of trading. Not all your limit orders will get filled, but at least you are not glued to the charts waiting for an entry for hours and hours. Okay, so what is the other way to trade this? Of course, you can drop down to the lower time frames and watch for a structure shift. For example, on this 15-minute chart, you can see the shift in structure, the pullback, and then the rally towards the previous day's high. This is the most classic entry model we have been using for a long time. So, when you compare DCA cost average methods with the classic reward systems, there are a lot of things to keep in mind. The advantage of YOYO is that you almost never miss an entry. With the classic reward system, you can easily miss any setups. With cost average, you are not waiting. Just set your orders and go about your day. But with reward systems, you have to wait for a specific entry. But the big issue with the cost averaging methods is that you usually end up with smaller profits and bigger, sometimes gigantic losses. With classic reward systems, you normally get better profits and smaller losses. And when you use DCA, you will notice something. You will get like 80-90% of win rate because taking quick profits with small profits. With classic reward systems, your win rates will be much lower due to the instant stop losses. Let's talk a little about market structure and price bias and how both of them can shift pretty quickly. As you can see on the higher time frame chart, there is a clear 4-hour imbalance that lines up with a 4-hour supply order block. After some time, you can spot that inner swing failure pattern, and it sits right around that overall support and resistance flip area. And down below, we can also see the previous day's lows sitting right next to those equal lows. So naturally, what should we expect here? A pretty strong drop, a crash, because all the main price action concepts are pointing in the same direction, the bearish movement. To put it really simply, we are in a bearish market if you take a close look, since price keeps making new levels of lower lows. And if you look even closer, you'll notice it keeps following the straightforward pattern of using imbalances and supply order blocks to push down into the next leg. And when you keep following that pattern, you can see it actually played out the way we expected at the end. Price dropped and wiped out that previous day's low. But what happens inside the lower time frames like the 5-minute and 15-minute charts? What usually happens is actually pretty obvious. The inner trend, the structure shifting right at the point where our high time frame interest area sits. However, when you build your setups, you want to stay as tight and as clean as possible. A good rule of thumb is to use 1:2 ratio at maximum. And the reason is simple. We never really know how long the price may stall in that zone before taking out the previous low. We have no idea. Sometimes it can take only a few hours, and some other times it can take many days. Okay, let's get back to the higher time frames again and talk a little more about what is going on. Yes, the price is clearly crashing, but at the same time it is building up a pool of liquidity above, creating this kind of parabolic liquidity along with a weak empty imbalance thing on top. So how do we know when the trend is about to change? That's the big question everyone always asks. It usually starts when the bearish structures begin to fail, like when imbalances are not holding anymore or order blocks stop reacting or similar structure breaks. Then you will see a shift in a structure with a clear market structure break. And all of that together becomes a pretty strong sign that price action may be shifting and overall trend could be turning at this point. So basically, if you get stopped out while following the existing trend, you gotta ask yourself why that happened. Because most of the time, it's a great sign that the trend might be getting ready to change. If you look closely at this example, you can see the price was following a simple pattern of tapping into inner imbalances and reacting to supply order blocks, and that kept driving the market downward in a steady downtrend. But if at any point that bearish structure suddenly fails, you should start thinking that something is shifting here. It might be buyers stepping in and rejecting the price levels, hinting at a possible trend reversal to sweep that parabolic liquidity sitting above. And this is how you should look at these crashing or fast running markets, and how you can expect a trend flip at any moment. Completed the free trading course but still need more? My master classes teach liquidity, imbalance, and the market structure in detail. Combine them with forward and reverse trading using momentum superboxes and yo-yo cost average entry models. After that, you will master scalping with a one-screen free TradingView indicator, a revolutionary trading system. Finally, you will learn to invest your profits using my 10-year swing investing with working agent system. Interested? Please see the video description.